Oil stabilises after its worst 2 days in 5 years. Good morning and welcome to this edition of IG Live on Wednesday the 3rd of February. Quick check on the pre-market in London at the moment. We're expecting a lower start to the trading day today, and despite the fact we got this slight stabilisation in the price of oil yesterday, it was really all about BP and the effects of this low oil price. We knew it was going to be a bad number, and oh boy, did it come through as a bad number, and it gave a very negative swing to the trading day on the FTSE yesterday. And you can see that we are at what is a fairly critical level, back at this level at 58.92, which we had back in August last year when the Chinese markets took down global equities and the FTSE fell down to this level here. And so we are now bubbling around that sort of point on the FTSE 100. We're down about 1/3 on from yesterday's close. European markets looking similarly weak. We're down 1/3 at the moment on the German 30 and France 40 cash as we wait the start of today's trade. Let's take a look at some of these markets that have closed out the session today. Japan taking it particularly badly today. In amongst some of the stocks that are on the way down are those reacting to this loss that we've seen in the oil price. Nikkei down 3.1%. Shenzhen CSI 300 off the lows of the trading day, down 0.4%. S&P ASX 200, the Australian benchmark, taking a big hit, 2.3% lower. Banking stocks there particularly badly hit. In fact, the banking sector has really been one of those sectors that's really been knocked sideways so far in 2016. Let's look at what happened, remind ourselves what happened last night at the close on Wall Street. Particularly bad day for the Nasdaq Composite, down 2.25%. And we saw ExxonMobil come through with figures yesterday. These oil stocks and again banks, a drag on the indices yesterday. Dow Industrials down 1.8%. Similar sort of percentage move for the broader market index, the S&P 500. And the early look at the US markets on the IG platform. You can get a positive reading here. You can see there the Wall Street cash, the Dow Industrials up just a touch, but nonetheless off yesterday's lows. Now, let's take a trip to a Melbourne newsroom to get an update on more of what's been happening overnight in the Asian markets. We're off now to speak to Angus Nicholson. Angus.
The worst two-day performance in the oil price since 2011 has not made for a pleasant Asian session today, with heavy selling seen across the region, but particularly in Hong Kong and Japan. Most of those indices losing about 3% or more today. But particularly that oil price has really hit energy stocks across the region, with energy sectors being the worst performing by a long shot across the region. The ASX has had a very weak day, not only there in the materials and energy sector that have been really hurt in the risk-off sentiment seen over the past 24 hours or so, but also the banks on the ASX have had a very difficult day. NAB, of course, about to sell off the Clydesdale Bank shares, which of course have now been taken out of the market capitalization valuation of NAB stock, and has seen it have very heavy selling today, and big questions about how the Clydesdale Bank stock will be performing when it is properly issued tomorrow in the ASX. But the Hong Kong shares have had a very difficult day. Partly that seems to be driven by the sell-off in the energy price, but also the fact that new, stricter FX controls have been implemented in China, restricting the purchase of foreign currency denominated insurance by Chinese citizens. This is the latest in a round of stricter FX controls that China is implementing to try to stem the capital outflows that we are seeing in the country, and that has further dampened the already very weak Hong Kong markets.
Angus, thanks very much indeed. Angus Nicholson there in a Melbourne newsroom, just running through the major features of today's trade in the Asian markets. In just a minute, we'll be talking with Wei Li from iShares at BlackRock about the day and next few days ahead. But let's go first of all to our trading room floor and Alistair McCaig, who joins us with some more of what our clients really should be focusing on today, because once again, there's a wide breadth of news to follow, from Brexit to Bank of England to non-farm payrolls at the back end of the week. And as we're hearing there from Angus Nicholson, also Clydesdale Bank. What should be uppermost in people's minds at the moment, Al?
Well, I think from the equity side of things, GSK is certainly one to keep an eye on. They're not due to actually post their figures until later on, tail end of the morning session. They're probably going to face some headwinds from the currency market. We're expected to knock their figures by about 3%. Rather underwhelmed, I think it'd be fair to say. But being a defensive sector, defensive stock, as it were, it's performed, I guess, better than many of the other sectors that we've seen in the FTSE, and broadly speaking, has been better behaviour. Clydesdale Bank is going to garner a bit of focus as far as UK markets are concerned. As much as anything else, for sentiment's sake, it does potentially offer the government a little bit of a glimpse as to what the appetite is from the investment community as far as the banking sector is concerned. I'm sure with Lloyds at the back of their minds, they'll be keen to see exactly how successful that has been. It's been a stuttering start, the fact that they've delayed their IPO due to the fact that debt rating agencies didn't feel they had sufficient news flow. Undoubtedly the right decision, but by the same token, rather sets a precedent of a little bit of a worry as far as the stock is concerned, added to which the IPO price is at the bottom end of the range. Not quite the dead bottom, but pretty blooming close nonetheless. Worth noting, of course, pretty much every front page of every paper has a review of Cameron's negotiations as far as the EU treaties are concerned. Yet from yesterday, broadly speaking, they're pretty negative across the board. Sterling will undoubtedly have some ramifications on the back of that. We'll undoubtedly see cable move on the back of that. Services data out as well for the UK is so important for us. And talking about services data, obviously we had Chinese service data out yesterday, an increasingly important part of the Chinese economy. Worth noting, 6-month highs. We had been hoping, desperately hoping, I think it'd be fair to say, and certainly from the Bulls' point of view, that we were going to see a little bit more encouragement out of the Chinese economic data. Maybe this is something that gives us a little bit of a light at the end of the tunnel, or rather been swamped, as Angus had pointed out, due to the troubling oil prices. But nonetheless, an encouragement as far as that service sector figure is concerned for China. Maybe not going to be replicated, unfortunately, as far as the UK is concerned.
OK, Al, thanks so much indeed. Some of the points to watch as we go into today's trading day across the European markets. Markets expected to open in 3 or 4 minutes' time. Wei Li from iShares at BlackRock joined us now. Good morning to you. First of all, I mean, the point that Alistair was making for Angus as well about China and the wide ramifications it has for, I mean, we had these trying to stem these currency outflows in China and so forth. I saw you nodding your head when Angus was talking about that. What are the implications for us here in the UK about what's happening in China?
Well, UK is a big trading partner of China, so any stabilizing on the data front, as far as China is concerned, could be positive in terms of sentiment for UK. But right now, as you said earlier, that Brexit is very much weighing on sentiment, so that could actually drive market movement in the near term.
What sort of market movement is it already driving? Because there seems to be this wide swing between will we leave or won't we leave, and what the ramifications are. What are you seeing in terms of flows?
I think we have, well, so far if you look at flows, we have actually seen a lot of inflows going into FTSE 100 exposure in terms of ETP flows, and that is really quite interesting, especially with the Brexit discussion hanging in the background and with the earliest date as early as June. So we see UK market outperforming broader markets, flow going into UK equity market. Definitely it feels as though investors are positioning for a more market-friendly outcome, but right now as far as polls goes and also as far as the headline goes, it could go either way. So this is really interesting to note the contrast between flows and where market seems to be heading towards.
That surprises me, because uncertainty, markets and investors and traders hate uncertainty, and indeed this is a very, very uncertain situation. So to be putting money into ETPs in the UK is surprising. Is that exclusively driven by Brexit, or are there other factors at play here that UK maybe safe haven? I'm not sure. I don't know what the
safe haven could be one, but I think a bigger driver would be the more dovish than expected BOE rhetoric so far that we have heard year to date. I think right now, if you look at the number of hikes that are being priced in the futures market for the BOE is 0 in 2016, and later 2017 we could see a hike being priced in. So the fact that markets are getting more used to this lower for longer environment as far as central banks is concerned in the UK has boosted sentiment, especially when we look at the equivalent in the US, which is that we could see more hikes later on this year.
Bank of England, of course, reports tomorrow its interest rate meeting, but it's Super Thursday. It means we get the inflation report as well.
Absolutely.
What's that going to tell us?
That is going to probably reflect a rather disinflationary pressure in account of oil weakness so far year to date, as well as in the previous in the months leading into that, and we would expect more dovish rhetoric on the back of it, as well as we have seen so far from other central banks.
Okay, stay with us just a minute. We're just going to see the European market open. We'll talk about sterling in just a moment's time. The European markets are just about to open for the session today. Let's just take a look at where we are with these declines, and in fact, as I speak, we are eating into the earlier losses that we had. As I said, we've seen a small stabilisation in the price of oil. I do want to bring up Brent crude. In fact, as I speak, Brent is making a little bit of a comeback. If we can look at the chart here, this is a daily chart for Brent. There's the last 2 days that we've had, the worst 2 days since 2011, as Angus was talking about, not just Brent, WTI as well. That's the daily chart. Looking at it on a 1 hourly chart, you can see the way in which things have pulled back, and we've hit this bottom. In fact, it's an interesting level. We've got 32.30 is where we bounced off from on this hourly chart here, and if we go back, you can see it has previously been a point at which we've seen a little bit of resistance. We broke through that, and since then we've been trading in this band between the 38.19 and the 32.30. So that's where we are for Brent, and of course this has wide ramifications for the UK stock markets because of the large number of oil companies that we have in the FTSE 100 and also FTSE 250 as well, that rely on a higher oil price. That's just not what they're getting. Wei, let's get back to you if we can, talk about this low oil price and the effects of it, because we hear so much about the fact that it's good for an economy, it has potential to enable an economy to grow. But there are, at these sort of levels here, big question marks now about some of the big oil producing economies because the oil price has come down so far. What risk does that pose to what would otherwise be a fairly good environment to trade when you've got a low oil price?
I think what we have seen so far year to date is this disconnect between how much the exporters are hurting versus how much the importers are actually benefiting. So what we have seen is that the exporters are hurting straight away because of the fiscal negative drag, versus the importers with the consumption benefits feeding through with a lag, and on aggregate we see negative weight on market sentiment. What we have also seen, which is really quite interesting in terms of oil price, exactly as you say, in the long term you would think that this consumption boost will be positive for sentiment, but so far what we have seen is that the correlation between oil price and risk sentiment has actually gone into quite positive territory, and a few drivers behind this positive correlation that is sometimes or somewhat counterintuitive. The first one being sovereign wealth funds are probably getting forced to sell out of their dollar-denominated assets. So if you think about globally, we have more than $7 trillion of sovereign wealth funds, and more than $4 trillion out of that is coming from oil exporting, commodity exporting economies. And now with oil price and commodity prices coming under pressure, they have been forced to dump their dollar-denominated assets into the market, and that has been serving as a dampening factor in terms of risk sentiment, which would explain why this correlation between oil price and risk sentiment has turned positive. And the second driver of that, exactly as you say, is lower oil price. People started to question, what is that telling us? So far we have been of the opinion that it is supply driven, and we continue to think it is excess supply weighing down on sentiment that's ultimately driven down oil price. But then increasingly, in light of recent manufacturing data from both US, Europe, and to some extent from China as well being quite soft, people are starting to question if the oil price is telling us something about the future growth outlook that is currently not being priced in.
Okay, all right, thanks so much indeed. Just to quickly go back to BP share price, because this time yesterday we were talking about that massive great big drop. We are seeing this stock up 0.25% today, so eating into those losses, just talking about some of these oil stocks. Just one other stock I want to talk about very quickly, and that is Hargreaves Lansdown, which has seen a loss of 3.2% at the start today, on from the numbers out this morning. Strong new net business inflows for 6 months, but the company does acknowledge that obviously the markets are very weak. got the FTSE All Share of 3.5% drop. There we have the figures that you can see there. Profit before tax up, net revenues up, interim dividend up 7% as well. But these numbers obviously reflecting what was otherwise very poor market condition for those that are using stocks as a base for their future. Instead of that, there's a lot of people holding cash at the moment. You can see that in the way in which the markets are acting. So Hargreaves Lansdown, one of the poor performing stocks, topping the FTSE 100 losses at the moment, with a drop of 3.5%. Well, if I can get back to you and talk a little bit about sterling, what are the forces on sterling at the moment? We're talking about the Bank of England tomorrow. There has been this weakness in sterling. What is the sentiment behind the foreign exchange markets for the pound at the moment?
I think right now the more dovish than expected sentiment from BOE has been very much weighing on the year-to-date weakness of the sterling, and the fact that in forex market people seems to be more sober and more more negative about the outcome of Brexit discussion has also been weighing on sterling. This is in sharp contrast with the relative performance of the equity market, where people seems to be more positive and more optimistic about the Brexit discussion.
Yeah, 144 at the moment for pound against the dollar. One other thing I do want to discuss here before we wrap up is the non-farm payroll data on Friday. How critical is this going to be this time around? Because we are hearing consensus views. We could see anything like about 100,000 less than we saw last month. Yes, last month, 292,000. It's a blockbuster number. So we're expecting a 190 number this time. What do you think are going to be the big features out of Friday's non-farm payroll to watch?
Something that we will pay a lot of attention to would be the wage growth. So far, if you look at the previous report, wage growth seems to be missing expectation by just a little bit. But if you look at the ECI data that came out last Friday, it seems to suggest on a quarter-to-quarter basis, wage growth is still reasonably robust. So we would like to take guidance from the wage component of the non-farm payroll report this Friday and see if we are on track with this inflationary pressure coming through in the US labor market. In terms of the headline growth, I think, yes, market is expecting slightly less than 200K, but around 200 would probably be just good enough in terms of expectation for what that might mean for a future Fed rate hike path.
Well, like the FTSE futures, about the sterling futures and the expectations for the Bank of England to move, the expectations have been reined in with the US Fed as well, aren't they? No longer expecting 4 this year, are we?
Not at all. Market was expecting 2 rate hikes for 2016 versus the FOMC members themselves saying that they're going to hike 4 times. And that gap has actually widened year to date. So we're talking about 0 versus 4, which is incredible given the fact that the wider the gap, the greater the uncertainty and more Fed-related volatility to hit the market.
Okay, all right. Thanks so much indeed for joining us there, Wei Li from iShares at BlackRock. That pretty much sums things up for the market open this morning. Just a quick look at these European markets again, because, as I said, we've been eating into the earlier losses. London's FTSE, one of the better performers, as we were just hearing, that funds, the ETPs, are seeing money going into the FTSE 100. And we've got at the moment this market looking as though it wants to get back to the point at which it closed out yesterday. The movers, quick look at what's happening here in London, just to show you exactly where Hargreaves Lansdown is compared to the rest of the market there, down 4.25%. Best performer, Chip Baker, Chip Licensee Arm Holdings, up 1.9%. That's it for this edition of IG Live. We're back at 10:30 this morning, charting the markets this morning. Chris Beecham will run through some of the technical analysis on some of those charts they're watching here at IG.